Hey everyone, welcome to another accounting video. This one I think quite good because it forms the building blocks of our reports that we're going to be referring to from now on in practically all our reports in some capacity. This is applying to both year 11 and year 12. So what today's video is going to be is quite simply the anatomy of the three reports we make at or in VCE accounting. They are the cash flow statement, the income statement, and lastly the balance sheet. We have done the balance sheet a little bit, so I'm going to spend a little bit less time on that one, but we are going to go and look at the cash flow statement, and we are going to look at the sorry, my nose is a little itchy. And we're also going to be looking at the income statement, cash flow statement. We're going to be seeing how those tie in. So, without further ado, let's jump into it. So, we are going to start with the cash flow statement. So, it's up on the screen now. You can see it. It's a very long document. I'm not going to go through the itemized list because that's going to come up when we go into specific topics like, say, GST or accounts payable, accounts receivable, or anything to do with inventory. Like, those little topics are going to come up as we go through. What I want to do is more focus on the headings and the overall structure. And just I want to note two things here as well. So, at the top, you can see we've got the business name, the statement, the date. Cool. Nothing out of the ordinary so far. But the first thing is the cash flow statement is divided up into three separate areas: the operating activities, the investing activities, and the financing activities. So those three subsets and a little summary at the end. So I'm going to go through the subsets. So operating activities is your business's day-to-day items. So, for example, things that day-to-day might be customers paying us back, we make cash sales, all those elements. Things that would happen, or you'd be considering fairly normal, essentially. Fairly normal, I think, is a nice little starting point. Now, let's have a look, zoom in a little bit, and you can have a look at the operating activities. You see cash inflows, cash outflows. There are two ways the cash inflows and the cash outflows are done. The first way, and that's going to be on your left, is here is cash inflows, less cash outflows, giving you a net amount. The second way, on your right, then this is screen right obviously, is the brackets. The brackets just mean bank goes down, or you have lost, or not lost this money. That's the wrong term, and you'll see why when we get to the income statement. But our cash has gone down. It's reduced. We've used some of this cash. So there are two methods there, and at the bottom you can see net cash flow from operating activities, and you can see also the two columns. Every column on the left is filled, but on the right, it's just essentially a summary. If we move down, we can see both the investing and financing activities. And the investing and financing activities are very, very niche. They display very specific information. The investing activities, both inflows and outflows, talk about when we buy, and that's going to be outflows because we pay money for it. When we buy a non-current asset or we're investing in the business, when we buy a non-current asset, that's where that information will go. If we buy an asset, it's going to go in the outflows. If we sell the asset, it's going to go in the inflows because we receive cash for the asset, or we sell it. We buy it, and that makes our cash go down. Likewise for financing activities. In the inflow column, we can only receive two types of things that really change what is essentially our debt ratio. Now, we do debt ratios at the back end of the year, but all you need to know is, do these affect the stability of the business, whether that is owner's stake or big type of loan? So think your bank loans. So a cash inflow, there's only two lines that can be a cash inflow. That is capital contribution by the owner, and secondly, we receive a loan. And the outflows, the only two outflows will be drawings or you pay back a loan. If you put anything apart from those four on the screen, you put any of those four on there, you have stuffed up. You have done the wrong thing. You need to double check your work. So remember, it's capital contribution, capital contributions, receiving a loan, drawings, and paying back a loan or the loan principal. Not the interest, the loan principal. Please remember that. Interest obviously going in the operating. So at the bottom, you can see here net cash flow from financing. So that's again that summary. But then we have the bottom three, net increase or decrease in cash position. That is just adding together the net cash flow from operating, net cash flow from investing, and net cash flow from financing, and going, cool, this is how much my cash position changed. We then add that onto the bank balance at start, and we receive a bank balance at end. It's a nice little summary. So a nice little quick cheat code now for your cash flow statement. When you're classifying everything, do investing and do financing first, because there's only 6 transactions that can go in investing or financing, 2 in investing and 4 in financing. Everything else has to be operating. So operating will be your biggest one. That's just a little trick you can try. Again, practice makes perfect. And the other bit I want to draw your attention to is the bank balance at end, that 3,500. That is what we use, just that one line. That is the only line we lift directly up from that report and put it in the balance sheet. So just a little sidebar there. Now we're going to move over to the income statement. Income statement is, especially for year 11, going to change a lot more. For year 12, it's pretty much set in stone. What you see for year 12 is what you get. Year 11s, this is what you'll be doing by the end of the year. So there shouldn't be anything really out of the ordinary. All right, so you have the revenue section. We start off with our cash credit sales. That any sales go in the top part in that revenue. Less sales returns. Make sure we always put sales returns and ergo net sales. Then we have less cost of goods sold. Now, when we do inventory, that's going to come a bit more into play. But for the time being, the only thing we care about is cost of goods sold, which is the expense we incur when we sell inventory. Again, we do this in the inventory video, so don't be too concerned now. And then you get your gross profit. This is primarily how much money we as a business make just selling items. Next, we then have our inventory loss. So if we lose inventory, then, or through theft or whatever, that would go under there. And there's also other aspects we do, again, in the inventory video, shockingly, which is our adjusted gross profit. And then lastly, we do our other revenue. So if we have investments that aren't direct sales or discount revenue, as you can see on the screen, they are added there. And you're given with a final number. That is your final revenue number. We then minus our other expenses, our day-to-day, our operating expenses. And some of these are going to be from the cash flow statement. That's just how this works. Because some of those expenses we pay for in cash. So that's where that comes in. You subtotal that. Again, very similar to what happened in the cash flow statement with your summary on the right. But you just got to make sure you're taking note of the key numbers you need. So a little trick I like to do is put a little arrow next to the key numbers, as I've done on the screen here for you. Now, after that, you are deducting the total expenses from the final revenue number under the discount revenue. And you're going to be given a net profit figure. And this will play into our balance sheet, because this is the number we take from the income statement. We take that number and we put it in the balance sheet. So we bring up the balance sheet now. We know a classified balance sheet. That's nothing scary for us. But what gets us interested is the 3,500 is a direct number in the current assets from the cash flow statement. So you left that number directly. Meanwhile, in the owner's equity section, you can see we've added the capital contribution, we've added the net profit, but we've deducted the drawings. All this information has been gathered from the cash flow statement and the income statement. This is where you pull those numbers in. That's where you got to be aware of different things. So the big takeaway from you, or for you today, I think, is looking at the owner's equity section, understanding it is starting capital. That 27,650 is a starting amount. You add the contribution, you add the net profit, you minus the drawings, and you minus the net loss if there's no profit. If it's a loss instead of profit, obviously you will minus it, and you'll be given a new number that says this is the current amount of capital. And the interesting thing is that capital, that 21,880, the following year, so if we do another one at December 31, 2026, that 21,880 is the new starting amount. So from there, just make sure when you do your balance sheet, you pull from the right numbers. Make sure you include your numbers. We're going to be coming back to the balance sheet a lot. So don't worry if this is confusing. This is just ground zero. But until next time, good luck with accounting. Share with people you know, and we'll go from there. See ya.